In 2020, the COVID-19 collapse and the V-shaped recovery. It was the final days of 2019, and a mysterious pneumonia case emerging in Wuhan, China initially seemed like a local health issue. No one in the world yet realized that it would soon turn into a crisis that would deeply shake the global economy and financial markets. At that time, optimism dominated the stock markets. Especially in the United States, equity markets had been in an upward trend for about 11 years. Corporate profitability was strong, unemployment was low, and investors had a high appetite for risk. Many believed the next decade would continue with similar growth. However, an invisible threat would completely reverse this picture within a few weeks. On January 30, 2020, the World Health Organization declared the novel coronavirus outbreak a public health emergency of international concern. Despite this, markets initially paid little attention. Many investors believed COVID-19 would be contained, as with previous outbreaks. By mid-February, the danger began to reveal itself rapidly. The virus was spreading not only in China but also in South Korea, Iran, and especially Italy. Production was slowing, supply chains were breaking down, and international flights were being cancelled. On February 19, 2020, the S&P 500 index reached what was then its all-time high. However, this peak also marked the beginning of a plunge into dangerous waters. The virus was no longer just a threat to healthcare systems but also to the global economy. Factories were shutting down, consumption was slowing, and populations around the world were preparing to stay home. In such an environment, it seemed extremely difficult for companies to sustain their operations. From February 24 onward, global stock markets experienced sharp sell-offs. Investors seeking safe havens moved out of equities into cash and government bonds, while uncertainty overshadowed pricing. On March 11, 2020, the World Health Organization officially declared COVID-19 a pandemic. On the same day, then U.S. President Donald Trump announced a temporary suspension of travel from much of Europe to the United States. These developments further shook the markets. In the following days, scenes rarely seen before unfolded on Wall Street. Due to extreme volatility, the circuit breaker system, which temporarily halts trading, was triggered several times. The sharp declines on March 9, 12, and 16 demonstrated how quickly investor psychology could change. By mid-March, not only markets but daily life itself had nearly come to a halt. Many countries closed their borders, imposed lockdowns in cities, and shut down schools, restaurants, and shopping centers. Flights were cancelled, production was suspended, and millions began working from home. These developments completely reshaped investors' expectations about the future. Financial markets reflect not only current conditions but also expectations of future earnings. The fear that the global economy would largely shut down made corporate profit expectations highly uncertain. After peaking on February 19, the S&P 500 index lost approximately 34% of its value within just 23 trading days, reaching its bottom on March 23. This became one of the fastest bear markets in modern financial history. While similar declines during the 2008 global financial crisis unfolded over months, in 2020 the same scale of loss occurred within weeks. The VIX index, one of the key measures of market fear, rose to around 83, levels comparable to those seen during the 2008 crisis, indicating extreme uncertainty in the markets. Energy markets were also severely impacted. With travel cancellations and slowing industrial production, demand for oil dropped sharply. Due to insufficient storage capacity, the May 2020 futures contract for U.S. crude oil traded at negative prices for the first time in history on April 20. This extraordinary situation resulted from the technical structure of futures markets. The global economy deteriorated rapidly as well. In the U.S., millions applied for unemployment benefits. Global trade slowed, tourism came to a complete stop, and countless businesses were forced to suspend operations temporarily. By the end of March, one question echoed around the world: would this crisis be as prolonged as the Great Depression of 1929 or the 2008 financial crisis? In response to all these negative developments, governments and central banks initiated the most comprehensive intervention in modern financial history. The U.S. Federal Reserve cut interest rates to near zero through emergency meetings in March. It also injected massive liquidity into the financial system by increasing purchases of government bonds and mortgage-backed securities. At the same time, the U.S. Congress passed the approximately $2.2 trillion CARES Act stimulus package. This package included direct cash payments to households, expanded unemployment benefits, and financial support for businesses. Similar stimulus programs were implemented in many countries around the world. On March 23, 2020, the same day the S&P 500 reached its bottom, the Fed announced new programs to support credit markets. Interestingly, while economic data continued to worsen, stock markets had already begun to reverse direction. The reason, as always, was that financial markets priced not the present but expectations about the future. Investors began to believe that these programs would limit economic damage and that activity would gradually resume. Another factor supporting the recovery was technology companies. People were working from home, receiving remote education, and shopping online. Demand for cloud computing, e-commerce, and digital communication services grew rapidly. This shift accelerated the growth of major technology companies and played a significant role in the rise of U.S. stock markets. However, the recovery did not occur at the same pace across all sectors. Tourism, aviation, and traditional retail remained under pressure for a long time, while digital sectors grew much faster. For this reason, the term V-shaped recovery mostly described major stock indices. Later in the year, positive news from vaccine developments and the gradual reopening of economies further boosted investor confidence. In August, the S&P 500 surpassed its pre-pandemic peak and reached new record highs. Thus, one of the fastest recoveries in modern financial history took place. However, this crisis left investors with important lessons. Many who sold in panic in March 2020 missed one of the fastest recoveries in history. Those who stayed committed to their long-term strategies were able to benefit from the rebound. The COVID-19 crisis demonstrated not only the fastest bear market in history but also how investor psychology, central bank actions, and economic expectations can shape financial markets. Looking back today, 2020 is remembered not only as a year of a pandemic but also as a historic turning point that reshaped the direction of the economy, technology, and the investment world. Perhaps the most important lesson from this period is this. In financial markets, the biggest movements often occur during times of greatest uncertainty. Just as fear can spread rapidly, confidence can return just as quickly when the right conditions emerge. If you enjoyed this video, don't forget to subscribe to the Stock Market Historian channel. We will continue exploring the stories that shaped the history of the stock market together.